Today we will be discussing 10 things you need to know about decentralized finance and how it is a potential game changer. So, let's get going. Decentralized finance, or DeFi, refers to a financial system built on blockchain technology that operates without traditional intermediaries like banks or brokerages. Instead, it uses smart contracts, self-executing agreements coded on blockchain networks like Ethereum, to automate financial transactions such as lending, borrowing, trading, and earning interest. Decentralized finance allows users to access financial services directly, peer-to-peer, without needing to trust a central authority. This system is transparent, global, and typically accessible to anyone with an internet connection. It also offers more flexibility and lower fees compared to traditional finance. Despite its benefits, decentralized finance carries risks such as smart contract vulnerabilities and regulatory uncertainty. Nonetheless, it represents a significant shift towards a more open and permissionless financial ecosystem, which is gaining attention from the consumer. So, in this vast new world of decentralized finance, what comes next? Before diving headfirst into decentralized finance, it's essential to understand several key aspects to navigate this space safely and effectively. So, here are 10 of the most important things to know about decentralized finance. Number 1. Understand blockchain technology. Decentralized finance operates on blockchain networks like Ethereum. Familiarize yourself with how blockchains work, including concepts like smart contracts and decentralized applications, also known as dApps. Number 2. Know the risks of smart contract vulnerabilities. Smart contracts automate decentralized finance transactions, but are vulnerable to bugs and hacking. Audits and code reviews can reduce risks, but there's no foolproof solution. Number 3. Market volatility. Cryptocurrencies, which form the backbone of decentralized finance, are highly volatile. Sudden price changes can impact investments and returns significantly. Number 4. Gas fees. Transactions on blockchain networks require fees, or gas on Ethereum. High network usage can make these fees expensive, affecting profitability. Number 5. Custody and security. In decentralized finance, you manage your own funds through digital wallets, meaning there's no middleman to recover lost or stolen assets. Secure your private keys and use hardware wallets for added safety. Number 6. Impermanent loss. When providing liquidity to decentralized exchanges, you may experience impermanent loss due to fluctuations in token prices. This can affect potential returns. Number 7. Regulatory uncertainty. Decentralized finance operates in a largely unregulated space, and future government actions could affect platforms, tokens, or user access. Be prepared for evolving regulations. Number 8. Yield and liquidity farming risks. Yield farming, or earning interest by lending or providing liquidity, can offer high returns but often involves complex strategies and risks, such as liquidation and rug pulls. Number 9. Know the platforms. Each decentralized finance platform offers different services, such as lending, borrowing, or exchanges. Research their credibility, user reviews, audits, and the team behind them before using them. For example, for finance-related transactions, Ethereum powers DeFi apps like Aave and Uniswap. But for real estate, platforms like Propi facilitates blockchain-based real estate transactions. Finally, number 10. Start small and diversify. Given the risks, start with small investments and diversify your exposure across different platforms and projects. This reduces the impact of any single loss. By understanding these factors, you can better manage risks and make more informed decisions in the DeFi ecosystem. Now, let's move on to the game changer. Who can benefit from using decentralized finance? Let's take a look. Decentralized finance offers a wide range of benefits to various groups, especially those underserved or restricted by traditional financial systems. Here are 5 examples of who stands to benefit the most from decentralized finance and how they can use it in ways that can be more advantageous than traditional finance. Number 1. Unbanked or underbanked individuals. These individuals can benefit because they will have access to financial services without a bank account. For example, people in developing countries or those without access to banking infrastructure can use decentralized finance platforms to store value, send payments, and even take out loans. Traditional banks may require specific documentation or minimum balances, which decentralized finance does not. Number 2. Small businesses and entrepreneurs will benefit due to easier access to capital and liquidity. For example, decentralized finance platforms like Aave or Compound offer lending and borrowing services without needing credit checks or collateral requirements, typical of banks. Small businesses and startups can secure loans directly from lenders on decentralized networks without lengthy approval processes. Number 3. Investors seeking higher yields can benefit because they can earn better returns on assets through decentralized platforms. For example, yield farming and staking on decentralized finance protocols can provide significantly higher returns compared to savings accounts or bonds in traditional finance. Also, liquidity providers earn fees and rewards for contributing to decentralized exchanges like Uniswap. Number 4. Individuals in restrictive financial environments can benefit because they gain freedom from government restrictions and capital controls. For example, people in countries with strict financial regulations or high inflation, like Venezuela, can use decentralized finance to store wealth in stablecoins, such as DAI, or invest in crypto assets, protecting their money from devaluation or confiscation. Number 5. Freelancers and gig workers benefit from quick and global payments with low fees. Because decentralized finance allows freelancers and gig workers to receive cross-border payments instantly using crypto without high fees or delays from traditional payment systems like PayPal or bank transfers. Ethereum-based decentralized finance protocols facilitate rapid and low-cost payments. DeFi provides these groups with financial autonomy, lower fees, and faster transactions, making it a game changer compared to traditional finance. In conclusion, the main purpose of decentralized finance is to create an open, permissionless, and transparent financial system that operates without intermediaries like banks, brokers, or centralized institutions. Decentralized finance aims to democratize access to financial services, allowing anyone with an internet connection to engage in activities such as lending, borrowing, trading, and earning interest, regardless of their location or status, and blockchains are the foundational technology behind decentralized finance. They provide a decentralized, immutable ledger where transactions are recorded and validated by a distributed network of nodes, rather than a central authority. This eliminates the need for intermediaries to facilitate transactions or enforce trust. So, will you be utilizing decentralized finance? It could definitely be the wave of the future in finance. So why not? Let us know. If you enjoyed this video, please like, share, and subscribe.
See you next time.